All right, welcome back to my YouTube channel. My name is Marcus Auerbach. I'm a local real estate agent here with Keller Williams, and it's time for a real estate market update for January 2021. Yes, we have managed to finish 2020. Hopefully 21 will be a much better year. We are going to take a look what happened in the last 12 months here now that we have a full year's worth of data. And then at the end of the video, I'm also going to show a little outlook, what we can expect from the spring market and from 2021 in general for the greater Milwaukee area. So let's get right started here and take a look at what happened in the last 12 months. I only have three numbers here that are super important. The first one here is days on market. And just so you have a historic perspective, days on market used to be around 140 to 160 days. That is the time frame it took to sell a house. So the last years, the market has gotten faster and faster, and 2020 set a new speed record with just 9 days on market, which is really insanely fast. The next thing is here, as I hear a lot of complaints, people saying there's no inventory. You see that on the internet. A lot of agents even are talking about there is no inventory. And when you look at it factually, that's actually not true, because we have sold 8,719 single-family homes in Milwaukee County, which is up 5.9% from the previous year. So we had that inventory to sell the houses. They just popped up and moved really fast. This is why it looks like there's relatively little inventory sitting on the market. But in terms of overall inventory that we've moved throughout the year 2020, we certainly had inventory because we sold it. And then finally, of course, when you have a lot of demand and not enough homes, of course, prices are going up. In the case of Milwaukee County, we have seen the median price for a single family go from $175,000 to $193,000. So just by owning a home, a lot of people actually made quite a good chunk of equity last year. And in total, median homes are up 10.29%. Now, where is all that coming from? So when you look at the last 10 years, you can see a very clear trend. As supply of inventory is going down, prices are going up. So the real estate market is really very simple. It's driven by affordability, of course, but at the very basic level, it's supply and demand. And like I mentioned earlier, we just see a new trend, a demographic trend, a change in the last 3-4 years, and that is that millennials are actually now being the largest group of home buyers in the market, and they're also now becoming the largest demographic in the working part of the population. And so they do everything later. They buy houses later, they get married later, they have kids later, but now finally they've started buying houses, and this is what's driving the demand so much in Milwaukee. I've spoken extensively in past videos about it. You can go back and watch that, maybe watch the 2021 prediction that I posted last year. A good portion of that is talking about the change in the demographics. We have about 300,000 millennials in Milwaukee, so if they get married, that's 150,000 couples. And you can easily see what happens when 150,000 couples decide to buy in a market that sells about 8,700 single-family homes in a year. So, of course, we don't have enough, and this is what's driving up the prices. Now, I've taken an example here, that's close to me. I live, right between Cedarburg and Mequon. And if you would look today in Cedarburg and want to buy a single-family home, this is all there is for sale in Cedarburg. So we have at the moment, it's January, extremely low inventory, of course. That is the season where we have the lowest inventory in the year. Spring inventory is not here yet, but the buyers are already out. They're not seeing much for sale. So we have currently 19 houses, single-family residences for sale in Cedarburg. And it's interesting when you look through here, you see that 10 out of these 19 already have an accepted offer, and they're ranked here by price. So let me show you how this breaks down. So this is the segment from zero actually to $300,000. So there's nothing below $229,000. So this is all you got, and they're all already under contract. The next segment here would be from $300,000 to $500,000. Also here, 2 already under contract, not much to shop around here. And then you have $500,000 to $600,000. We have 4 homes, 1 is still available. But once we go past $600,000, you can see how the market changes, dramatically. Now over 600,000, things are moving a lot slower. This is also where we're seeing new construction homes. They're also priced usually in that area, and you can see the most availability we have here over $600,000. The line of competition is moving up. So like I said earlier, it used to be 200, 250 that was the most competitive. Now it moved up to 300, and I think this year we're already seeing early evidence of that. It seems to be pushing up to $400,000, where you have most of the competition. And it makes a lot of sense because people who have sold houses in the, let's say, $200,000 range, they are typically going to upgrade to, let's say, a $350,000, $400,000 home. We've seen that a lot with our sellers last year. We closed in total 52 transactions last year, and a lot of them were actually in that segment that they were, coming from either their first home or their second home and upgrading into a mid-range or into a luxury home. So this is the natural progression, and I think that the line of competitiveness is going to push up into that middle segment this year. We already see it in the data here. All right. If you're thinking now that Milwaukee is getting way too expensive, or the Milwaukee area is getting way too expensive in terms of home prices, take a look at this here. I have here shortened the list of the top 100 metro areas in the US, and they are ranked here by median home price. So you can see here the top 10 most expensive. Denver at $400,000 all the way up to almost 1.1 million in San Jose, San Francisco. So really up here. And then we have the bottom segment here, and Milwaukee here is at position number 61 with 193,000. So we are basically on the, between the second and the third, or top of the third. So still relatively low in pricing. If you look at Madison here, Madison is at number 32 nationally ranked with 260,000. And then here you have the changes from peak and since the bottom. So Milwaukee is doing fairly conservative here. We still have not hit peak value from the past, but we've seen a good improvement from the bottom. But here's the real kicker. Look at this. Affordability index, we are ranking here at a 3. So what is affordability? Affordability comes from home prices compared with interest rates and with wages, with median household income. So Milwaukee is doing very, very well. You really have to go down the list here to find more that are doing better than we are. And even here, a lot of them have a high affordability index. But then as you go up here, look what's happening here. They have all very high affordability indices. Madison here at a 7. So we have really excellent affordability in Milwaukee, and I think this is the one way of looking in it to say, okay, how are we doing in terms of, is real estate really expensive in Milwaukee, or where are we on that? If you zoom out and you see what's going to happen in the next 10 years in the future, where are we relative to that journey, and where could we be? One of the things that we also see changing is that as an impact from COVID, we have a lot of tech companies that now allow people to work from home, and they basically tell them it doesn't matter in which state you reside. And I'm getting more and more phone calls from people that are relocating to Milwaukee. They've been visiting here to enjoy the lifestyle in Milwaukee, and of course the low cost of living and the low cost of real estate. So this is, Milwaukee is still not a destination, like Denver or Austin, but we are seeing a significant uptick in the trend. I can just tell from the phone calls that I'm getting. So that's of course not helping with the inventory either. Here's a quote from Matt Fleming. He said, despite the best intentions of home builders to provide more housing supply, the big short in housing supply will continue into 2021 and likely keep house price appreciation flying high. So the builders play a significant role here, because we have only two ways how we can gain additional inventory in a housing market. Number one is building more houses, and number two is by basically old people passing away. And good for them, this is not happening. A lot of people are living longer, healthier, fortunately, so they're staying in their homes. They're not making them available for for the next generation in the marketplace. So, good for them, but not good for the housing market. And so those are the only two sources of supply that we have: new construction and vacancies. If somebody sells a house, buys a house, that's just a wash. So that doesn't really help. And the problem that we have with the builders in Milwaukee is that they're facing really strong increases in labor and material costs. So cost of new construction is going up. And if you're seriously looking for a new construction home, you can find a few where the base price is below 500, but it's really not that much of a home. So for all practical purposes, new construction really starts between 500,000 and 600,000 here in Milwaukee, and then goes up 7-8. So where are we in terms of inventory? Looking at a long-term picture, we are in a very hot seller's market, and you can see, back when we had a surplus of inventory building up, you can see this in days on market. And in a neutral market, we see about 5 to 6 here. They have 6 to 7 months worth of inventory. Right now, we have very low inventory, and this is our very fast-moving inventory, I should say. And this is what's driving the market. So if you think of the game musical chairs, where you run around the chairs until the music stops, that's basically what we have. We just don't have enough chairs. So here's a quick recap on home price changes. I showed this slide at the beginning of the pandemic, when there was a lot of concern about the COVID crisis crashing the real estate market. And a lot of the more sober analysts and experts back then, among them CoreLogic, were predicting that this is not going to happen in 2020. And turns out they were right, because when you look at past recessions, 1980, 81, even to some extent 91, we lost a little bit here, 2001, the real estate market always did very well during recession times. And so it did in 2020, as we now know. So this is a recession on the books where real estate did really well. The only exception here was 2008. And 2008 was different because it was not a recession that led to a real estate market crash. It was a mortgage crisis that led to a real estate market crash that led to a national economic recession. So it was a little different story here. In general, the real estate market is usually holding up or doing very well in times of an economic recession. So, of course, what is the consequence of home prices going up? We are seeing an increase in home equity. You might be surprised how much equity you have in your current personal residence. So here's some national numbers. 58.7% of all homes in America have at least 60% equity. Americans sitting on a tremendous equity. 42.1% of all homes are owned free and clear, and $177,000 is the average equity of a mortgaged home. So that is a lot of equity. This looks way different than what we had, for example, 10, 15 years ago. And the reason why this is important is when we look at forbearance. So as you will recall, there are a lot of people still enrolled in forbearance programs. So they're basically currently not making mortgage payments with the permission of the bank. The number is down. It used to be almost 6 million. So now we're down to under 2.7 million that are still in forbearance. But most of them have a very favorable outcome. And so they have never lost their job. They were worried that they might lose their job, and so they're resuming payments or they're restructuring the loan. But what all of them have in common, they have one big insurance policy against the ultimate threat, which is to end up in foreclosure. And that insurance policy is the equity. So two things have to happen before somebody goes into foreclosure. Number one, they have to be in financial distress, which obviously is very widespread in the country because of COVID. But the second condition that needs to happen is they need to be underwater with their home. And because on average homeowners have so much equity, they always have the option to just put their home on the market and sell it as a last resort. The market certainly needs the inventory. So this is why when you do some high-level math, you can clearly see that the threat of a huge wave of foreclosures, as some places in the internet are predicting it, is most likely not going to happen, because even the ones that are getting seriously in trouble, which is 18% out of the 2.7 million, they have the option, most of them have the option at least, to sell their home, put it on the market, cash out on the equity, walk away with the check, maybe pay off some credit card debt and whatnot, and start over. But they don't have to go through foreclosure as their only option because they have equity in their homes, and that's going to protect them. There are going to be foreclosures. It takes in Wisconsin about a year for a bank to go through the process. So we are going to see more foreclosures. But quite frankly, from a buyer's point of view, that is welcome inventory because we can certainly use more inventory in the marketplace. Let's take a look at equity across the US. Here's a nice chart that gives you a little overview. On average, $17,000 across the US. We're sitting here at $14,000 in equity gain. And I kind of like where we are in that position. I would be getting a little nervous if I would be out here in Washington with a $36,000 increase or $34,000 in California. Of course, one has to keep in mind that is coming, that's an increase from a much higher base because, average homes are so much more expensive out there. But, we're kind of in the middle here, doing much better than our friends in Illinois here, just saying. And $14,000 is what we have gained in equity on average per household in the US. Now, what are people doing with the equity? I found this really interesting because that was one of the problems that got us in trouble back in 2007, 2008, is that people were leveraging their home equity to go on vacation, for example, or pay off credit cards just to load them up again. And you can see here the amount of cashed out home equity. So that was not only available home equity lines, but actually used home equity lines was $240 billion back in 2007. In 2019, we are here at $89 billion. So homeowners are 3 times more conservative right now with their home equity, and they're being very, very careful to not over leverage themselves. So, that is something that I think is very healthy, and I'm really happy to see that here. So here's a quick math projection. What happens when you buy a home for $300,000 in January of 2021 at the current home price, appreciation rate, what's expected on a national level, you are going to see an increase from $300,000 to $354,000 by 2026. This is what industry experts are currently predicting. Of course, nobody knows. Nobody saw COVID coming. Who knows what the future might hold? But I think this is an interesting way of looking at it. And it also shows how the wealth and equity divide is opening up more and more. There's lots of studies, I'm sure you've seen some, about how homeowners are acquiring a lot more wealth and net worth compared to people that are renting. Here's the Housing Affordability Index. I just wanted to put that in here as a refresher. You've seen this before, so we are still doing quite well in affordability. We're still in the very affordable range because of the low interest rates and because of the increase in wages that we have seen. Even though home prices went up, the percentage that a household has to spend on average on housing is still a lot less than it used to be in the first 20 years here from basically 1990 to almost to 2008, so 18 years. So we're still here in a very affordable range. Yes, homes have gone up significantly, but when you look at it from affordability point of view, we are very much in the green here. Let's take a quick look at unemployment. So we are currently on a national level at 6.7%. We're doing better than national here in Wisconsin. And we have here projections from the Wall Street Journal and from the Fed. And you can see here it's going to, we've lowered unemployment rate very significantly in a very short amount of time. But now to get it from where we are currently, to get it down to pre-COVID levels, is going to be a very tough challenge, and it's going to take 3 years. And you can see that also mapped out here. So in red, you have the Great Recession from 2006 to 2016. So that was basically 10 years it took us to recover in terms of unemployment rate. In yellow, you can see what happened this year. So we went down sharp, we came back sharp as well. This was the much anticipated V-shaped recovery. And now we have basically, two scenarios depending on, which one you believe. It's going to be 3 to 5 years before we see the unemployment levels that we have seen before COVID. So there's another way of looking at it. We are talking actually about a K-shaped recovery, because for a lot of people, not much has changed. Their personal economy is doing really well. They have a job is doing great, company is doing great, no problem there. And so they really have experienced the V-shaped recovery. But then we have other parts of the population that have experienced, a downtrend. So this is why we call it a K-shaped recovery, because a part of the population went up and another part went down. And we have a lot of people that are still struggling massively, that are really financially at their wits' ends. A lot of them are not homeowners. Some of them are homeowners and are currently in forbearance. But hopefully we're going to see improvement on that end, that also this segment of the U.S. population can start seeing some of that recovery. But the implications of COVID have gone way beyond just the unemployment rate. They literally have changed how people are looking at housing in general. And I have here a quote from David Mealy, president of Homes.com, and he says, "The surge in the work from home population has rewritten the playbook for many home buying and rental decisions, from when and where to relocate to what people are looking for in their next residence." So I see that a lot on a daily basis, whether I talk to a seller who is looking to put their home on the market because they want something bigger, they're working from home, they need more yard space, a rec room, maybe a home gym. So these are very typical requests or desires that we see currently in the market. And that is really changing, like David Mealy says here, it has really rewritten the playbook in how these decisions are being made. Next, let's talk quickly about interest rates. So I have a quote here from Michael Fradatoni, and he says, "Treasury rates have really been moving up since the election, but mortgage rates have kept going down. So his prediction is we are going to see mortgage rates drift up with treasury rates as opposed to moving down and in the opposite direction." And that also lines up with the data that I have here. So we have here the quarterly forecasts for mortgage rates for 2021 from these four sources here, and then have the averages here on the right side. So you can see from 2.87 in the first quarter this year, and at the moment I'm seeing more like 2.7, but we are expected to slowly start drifting up more towards 3.05 at the end of the year. Of course, that will also change the math for home buyers, not by much. If you go through it, it's maybe $50 on an average house if you have a little higher interest rate, but it's certainly going to impact the buying power that buyers have in terms of how far up in the price range they can reach and still maintain a very affordable monthly payment with the low interest rate. Outside of interest rates, we are seeing strong numbers. So here are my lagging and leading indicators. And early in the year, we've seen a lot of red numbers here. But if you look at December here, the lead metrics have all been very, very strong and very positive. So based on that, we are going to see a very strong January and February. And with that, we're going to take an outlook here for the spring market for the Milwaukee area. Spring market is already here, at least as far as the buyers are concerned. We've written 4 offers last weekend, got 2 of them accepted. There's going to be more of that. Sellers are missing out on an early bird opportunity. Traditionally, sellers are always thinking they have to wait until spring. That's not true. Buyers are already out. A lot of them are looking, and as you've seen before on the Cedarburg example, there is just not very much inventory available right now. So fierce competition amongst those listings, and good for those sellers that are listing right now because they will have their sale taken care of. They will be under contract, and now they can focus on finding a new home for themselves as we are seeing more inventory coming up in March and in April. Millennials will continue to drive the market, no doubt about it. This is going to be a macro trend for the next 10 years at least. That is not going to change. And I think we're going to see price pressure from being focused mainly on the lower segment. We're going to see that start spilling over also on the medium price segment, on $300,000 to $400,000. I think we're going to see this to become very competitive this year. Builder confidence is very high. Cost of building keeps going up. Cost of lumber, land, and labor is increasing. And just general in terms of quantity, they're building as many as they can. But if you look at the numbers that they're cranking out compared to the overall size of the Milwaukee market, it doesn't really make a dent in our marketplace. I hope you got some good value out of this video. I would love to hear your questions and comments. If you're watching this on YouTube, you can just comment right here below in the comment section. I usually try to respond within 24 hours and would love to hear your questions and comments on this. If you got value out of this video, then please give it a thumbs up and consider subscribing. I have many more videos on my channel that speak to more specific questions about how to buy a home, how to sell a home. I have just finished a series about house hacking in Milwaukee. So if any of that is interesting to you, then feel free to check out videos on my channel. For now, thank you very much for your time. Thank you very much for watching, and I'll see you at the next one.